Welcome back to The Deep Dive, where we break down the latest earnings calls to get you up to speed fast.
And today we are really digging into Tilray Brands.
Yeah, their Q2 fiscal year 2026 results. The call was back on January 8th, and there's a lot to unpack.
It really is. This is a company that's, well, it's in the middle of a massive identity shift. They're working so hard to get away from that cannabis pure play label.
Right. They want to be seen as a diversified consumer packaged goods company, a CPG giant.
Exactly. Spanning beverages, distribution, global medical cannabis.
Yeah.
The works. And our mission today is to, cut through all that strategic talk.
To figure out what actually drove the number.
And to decode the signals that led to that little after-hours rally. We need to know if they're actually executing on the right things.
Okay, let's get into it. The market gave them a nod, but if you look just a little deeper, the story gets complicated.
It does.
So let's start with the headlines. The numbers that got investors excited in the first place. What were the high points?
Well, the big one was the top line, the revenue. It came in at a record $217.5 million. That beat the consensus, which was sitting around $210.4 million.
So a pretty decent beat.
Yeah, about a 3.4% beat.
Yeah.
And it's 3% growth year over year. So, in this environment, hitting your growth numbers it's crucial.
That's the good news. But then you look at profitability and it feels like a split narrative. The optics were great, but the core performance was maybe a little less inspiring.
You've hit it exactly. The non-GAAP EPS, which is what the street usually focuses on for, ongoing operations.
Right.
That was a net loss of 2 cents per share. Perfectly in line with expectations. No surprise there.
Okay.
But the really compelling thing, the visual for investors, was the GAAP net loss. Yeah. It narrowed a lot.
How much?
From a loss of over $85 million last year down to about $43.5 million this quarter.
Wow.
That dramatic cut helps management tell their story. The story about improving financial discipline.
But hold on. If they cut their overall net loss in half, why did the core profitability metric, the adjusted EBITDA, actually go down a bit?
That's the question.
It was $8.4 million this quarter, down from $9.0 million last year. To me, that suggests the big Jap improvement might be more about, balance sheet stuff than actual day-to-day profit. Is that a concern?
It absolutely raises an eyebrow. The market clearly cared more about the revenue beat and the story around liquidity and working capital. But you hit the nail on the head. That narrowing GAAP loss is likely from things like, say, reduced impairment charges, better inventory management, not from selling more high-margin products. It's important context.
So the top-line story is strong, but the profit engine is sputtering.
Sputtering a little bit, yeah. And that sputtering becomes crystal clear when we break down the segments.
The tale of two cannabis markets.
That's the strategic tension right there. You have, on one hand, just phenomenal execution in international cannabis.
That's the growth engine.
The undisputed growth engine. Revenue here grew 36% year over year. And get this, it was up 51% just from the last quarter, hitting $20 million.
And management was very clear about that.
Oh, very specific. This is the profitable path. This is where they're redeploying all their high margin supply.
And that strategy, that redirection, explains why the Canadian adult use cannabis revenue only grew by a modest 6%.
Exactly. They actually shipped their highest volume in Canada in 2 years, over 5.5 million units. So the demand is there.
But the strategic choice isn't. They're choosing not to sell into it.
Precisely. Management confirmed it. They are intentionally undersupplying the low-margin Canadian wholesale market.
Why sell it cheap at home when you can get a premium in Germany or Australia?
That's it. They're holding back inventory to push it into those international medical markets. It highlights a huge structural problem that they can't fix on their own.
Which brings us to the politics. The CEO made a really strong public statement, basically a plea to Prime Minister Carney.
Yep, for modernization of regulations.
Primarily excise tax reform. For anyone listening who doesn't follow the Canadian tax system, why is that one reform so critical?
It's almost existential for their profitability in Canada. The current tax is a fixed rate based on volume, applied really early in the supply chain.
So it punishes high-volume, low-cost producers like Tilray.
It gets their margins. It's an exorbitant tax percentage on their wholesale price. So if the rules don't change, the company is basically forced to export raw product.
And lose all that value creation, the processing, the branding that should be happening at home.
It's a policy failure, plain and simple. It forces companies to look abroad.
And that frustration at home just makes their financial foundation and international strategy even more important. Let's talk about the balance sheet. Management calls it their biggest strategic asset.
It really is the cornerstone of their whole diversification argument. They're sitting on very robust liquidity, $291.6 million in cash and marketable securities.
That's a solid cushion.
And more importantly, that financial discipline you mentioned earlier, it led to a huge shift on the balance sheet.
What was the shift?
They went from a net debt position last quarter to a net cash position of $27.4 million. They did that mainly by cutting debt by over $4 million.
And what about cash flow?
The turnaround was genuinely impressive. Cash flow used in operations was just a tiny $8.5 million.
Compared to what?
Compared to burning through almost $41 million last year. When you stop bleeding $40 million a quarter, that is a fundamental overhaul.
So they have control of their own house.
They do. And that confidence is why they reaffirmed their full-year guidance for adjusted EBITDA, keeping it in that $62 to $72 million range.
But to hit that number, they have to fix the single biggest problem on their books, the margin erosion.
And this is the flashing red light. The total consolidated gross margin dropped to 26%, down from 29% a year ago.
And we know exactly who the culprit is.
We do.
The beverage division, the craft beer portfolio they just bought.
That's the one. Beverage gross margin just compressed sharply. It fell from 40% last year all the way down to 31% this quarter.
That is a steep drop. It shows just how hard it is to integrate a complex, low-margin business like craft beer.
Right. It needs a ton of marketing, and the competition is intense.
And if you look at the revenue breakdown, you see just how much that hurts. Distribution, which is their lowest margin business, was almost 40% of revenue.
39%, yeah. Then cannabis at 31%, beverage at 23%.
So when your biggest segment is already low margin and your beverage segment margins are collapsing, the whole picture suffers.
It does. And that forces management to sell that strategic story even harder, to insist you have to see them as this diversified consumer company.
That liquidity, that nearly $300 million in cash, buys them time. Time to fix the margins while they grow the good stuff.
Time is the key.
So what's the actual fix for the beverage side? How are they stopping the bleeding?
They call it Project 420. It's this massive internal plan focused on set your rationalization.
Getting rid of the unprofitable beers.
Exactly, and streamlining operations. They said they've already hit $27 million in annualized cost saving in the first half of the year, and they're on track for their $33 million target.
So aggressive cost cutting, but that only goes so far. You need growth.
And for that, they are counting heavily on two things: spring retailer resets and new product innovations. They think that'll help in the fourth quarter.
It's a long-term play.
Very long-term play. But the CEO is still bullish on beer, not just for beer itself, but for the infrastructure, the distribution, the canning facilities.
All for future federally legal THC drinks in the U.S.
That's the goal. They already have 50% market share in Canadian THC drinks. They want that infrastructure ready to go when the U.S. finally opens up.
Which connects directly to the biggest catalyst out there: U.S. regulatory change, Schedule 3 rescheduling.
And management was very, very clear about their U.S. entry plan.
They were. They said their focus is not on some expensive state-by-state recreational land grab.
No. Instead, they're going for a federally compliant medical cannabis framework. They want to mirror the successful strategy they're using internationally.
They say they're ready to go with their Tilray Medical U.S. platform. That could be a huge advantage if the U.S. goes with a more pharma-style clinical approach.
It could be. And that medical pathway ties right back into their international growth. The global medical segment is on track for a run rate of $150 million annualized.
And the key driver is Germany.
It's Germany. They're leveraging their non-cannabis distribution business, Tilray Pharma, and they're on track to triple their medical cannabis footprint there this fiscal year.
It shows how those seemingly separate businesses actually work together.
It does.
But before we move on, we have to talk about the threat hanging over the hemp-derived THC market, things like their HDV9 beverages.
Right, the stuff that's legal under the 2018 Farm Bill loophole.
A loophole that seems to be closing.
The risk is real. Regulations could tighten up around November 2026, and if they do, that whole revenue stream could just vanish.
So what's their plan?
They're lobbying Congress, not for a free-for-all, but for regulated limits. Something manageable like 5 or 10 milligram formats instead of an outright ban.
Which brings us full circle back to the distribution segment. It drags down the margin, but it's also their biggest long-term asset.
Precisely. Distribution revenue hit a record $85 million, up 26% year over year. Management calls it the flywheel.
The flywheel.
Think of it this way. Tilray Pharma gives them pharmacy access and logistics all across Europe. The margin on distributing other companies' drugs is thin.
But that infrastructure is what lets them scale their own high-margin international medical cannabis business.
Yes, they're using their established sales force to push their own profitable products through the same pipes. It's a classic strategic acquisition.
So thin margins today for guaranteed high-growth channels tomorrow.
It's a calculated trade-off.
And that calculation sets us up perfectly for our final segment.
Yes.
It's time for our This Is Not Financial Advice segment, and as always, this is purely for entertainment and discussion.
We are not investment advisors. We're not telling you what to do. Investing involves risk, and you should always talk to a licensed professional.
Okay, with that out of the way, here's the outrageous but plausible trade pitch. The idea here is to capitalize on the specific story Tilray is selling,
while actively ignoring the parts of the business that are causing all the pain.
Management is all in on that $150 million global medical run rate, and they're leveraging their pharma infrastructure to do it. So this trade bets on that catalyst and that catalyst only, not rec, not beer.
The thinking is pretty simple. The company is trying to engineer a pivot away from low-margin Canadian wholesale and that tough craft beer space.
They want to become an international medical and distribution company. And you're betting the market will eventually value them on their strongest segment, not their weakest one.
The bet is that Project 420 will at least stop the bleeding in the beverage segment, taking pressure off the consolidated margins.
Which lets that runaway international growth story completely redefine the stock's valuation.
So the pitch.
The pitch is long TLRY call options. You're targeting a price that reflects that $150 million global medical run rate getting fully priced in by the market over the next, say, 12 to 18 months.
You're betting that the pivot, especially tripling their pharmacy reach in Germany, will fix the gross margin mix faster than Wall Street expects.
And that forces a re-rating. You're buying the stock not as a struggling beer company, but as a future pure-play international medical and distribution powerhouse. That's the narrative you're buying into.
It's a bold bet. It hinges entirely on management executing Project 420 and the market actually buying into this whole diversified CPG story.
So to sum it all up, the core tension is this. You have a company executing incredibly well on high-margin international cannabis. They're anchored by a ton of cash and a great distribution network.
But at the same time, they're fighting these huge headwinds in craft beverages that are actively dragging down their profitability. They have the time and money, but they need to fix that margin problem, and fast.
Which leaves us with the final question for you, the listener, to think about.
Given their very aggressive focus on a medical-only pathway into the U.S. post-Schedule III, leveraging clinical trials, pharma alignment, all of that.
As opposed to just jumping into state-by-state recreational markets.
Is that the smart, high-margin, long-term move that builds a sustainable science-backed business? Or are they sacrificing immediate growth that their competitors are going to scoop up while Tilray's busy negotiating with pharmacies in Europe?
That choice between a measured pharma entry and a consumer goods dash into the U.S. is probably the single biggest strategic question they face right now. We'll be watching.
Food for thought. Thanks for joining us on this deep dive.
We'll be back next time to break down another market-moving call. Until then, stay informed.